Hi everyone, I'm Chi, and we are talking about fundraising. Now, just to give you a little bit of background of who I am, I have been an active investor in venture and private equity for the last 15, 20 years. I've been focused in cannabis since 2016. Started a firm in 2018 called AFI Capital Partners, where we invest exclusively in cannabis. To date, we've invested in, I want to say, 23 companies, deployed about $60 million. And are really focused on this space and helping companies grow. The reason why we're talking today is really just to give you a sense of how the financing process works. As Amy said, it's important, but it's also just one step of the process. And it's something that has its own nuances and it has its own intricacies. And that's really what we're going to talk about and demystify some of that. The idea is that as an investor, I'm probably the one sitting on the opposite side of the table. So, this gives you a little bit of insight into what I'm thinking, and I'll give you some pointers as we go. I think the important thing to remember is that it's not something you're supposed to be versed in. Fundraising is a step in the process. Most of the time, good business requires good business and good capital. So it's only one piece of it. The goal of today's presentation is not to teach you how to negotiate a term sheet in its entirety. It's to do that in an hour would be a little silly. Rather, it's more about helping you develop a framework that you can understand your financing and that you can understand what you need, what you're looking for, and how to proceed. You'll notice there, I say, focus on what matters. Strip away the noise. Finance, just as much as any industry, has its own jargon. Everyone likes to sound self-important and say certain words. At the end of the day, it's about making sure that the business deal is clear to both you and to your partner. You should understand what the other side is looking for, why they're investing in you. And these little things are just business 101. In fact, I'd say a lot of my comments today are going to reflect and be pertinent to general entrepreneurship, not just cannabis. There's not too much cannabis in today's talk. I will flag when there are some of the cannabis-specific things. Sorry, marijuana-specific things. Just to give you some perspective from my side, if I think about my job, I probably spend 90% of my time looking for good businesses, working with entrepreneurs, and only 10% working on the financing. Financing is, again, just one piece of it. Again, it's one of these things that gets a lot of press and a lot of people focus on it, but at the end of the day, it's about building a great business. So here I've laid it kind of out in what a fundraising process looks like at 10,000 feet. The first step is sort of I call it planning your vision, laying out your story, telling people what you want. A lot of the presenters earlier, talked about some of these things, right? About how you should be structured, some of the things you have to watch out for, and later on you're going to hear some things about putting together a budget. These are all the tools that are important to communicating and planning that picture of what you're looking for. Some of the fundraising specific ones I want to mention, I put their sources and uses. And so it's important to note, what are you actually looking for, right? It doesn't mean you're necessarily going to get it, but if you're asking for something, it kind of signals how you're thinking about it, right? If you're saying, hey, I'm trying to raise $25 million to open one store, you're kind of setting a tone there, right? And then it's one of these things where you have a vision, you have a plan, stick with that, right? Don't try to raise money based on what people tell you what you should do or what's exciting. You should have a vision and a plan first that you can get behind and then be able to communicate that plan. The next step is the actual fundraising process, right? So this is where you'll hear about people who do a pitch or have a deck, a presentation. At the end of the day, what you're trying to do is communicate your vision. I break out the message into three major steps, right? Why are people excited about this space? Why do they believe anything you're saying? And then the last piece, why are they excited to back you as an entrepreneur? All three of them are slightly different questions. And you'll see in a lot of presentations, people talk about, the market. And they, let's be clear, if you're, people are investing in marijuana and they're looking at your business, They already know how exciting this space is. But it's still important that you talk about why people should be excited about the space, because it shows a lot of things. It shows that you do research, it shows that you're thoughtful, it shows that you've put in the work. It may not be necessarily about getting them worked up, but it's about showing them that you are a good entrepreneur and that you are believable. That second point, I always talk about it, your business is here and you want to get to here, right? And so how do you convince someone that you're believable and you're credible, that you're able to get a business from here to here, right? One of the ways I always talk about is like breaking it up into steps, right? Here's where we are today, here's where we're going. These are the 4 things that need to happen, and this is why I'm going to achieve all those things. So by making it into bite-sized chunks, it becomes a little easier. And then the last piece is, well, why should investors be excited about you in particular? And I think it's a crucial thing where it's not just like there's a great opportunity and we're going to do it together. You really need to say why you're the entrepreneur that it has the right resume for this job. And so often that'll come from expressing your convictions, expressing your beliefs, expressing why you're uniquely qualified for this role. Negotiation, that's the next phase. That's most of what we're going to talk about today. It's sort of the process of structuring an investment, how the pieces work together. I think the important things to talk about are both that there are traditional instruments and financial tools, and then there's also non-financial aspects, which again, I think a lot was covered in the legal presentation, sort of rights, covenants, governance, these things. And the last thing I want everyone to take away from fundraising, we're not going to talk about it today, but it's just a reminder that the fundraising process doesn't end when you've got the money. Often your investors are with you, so you're going to have to report. You're reporting out. And so you're going to have to keep them apprised of what's going on. And they're going to be involved in your business. So it's important to remember that when you're fundraising, it just doesn't stop. It's a constant process. So here, just to simplify things, I put some high-level buckets of kind of allow you to put some names to faces. You'll meet investors and they'll say, oh, I'm a this or that. Really, this is some very high-level buckets. Again, everyone thinks they're special, and so they may have some special adjectives of why they're different. But the buckets are, in general, friends and family, which is pretty self-explanatory. People who invest, friends and family who invest in you, believe in you. They may not understand the industry as well. They may a little bit, but really it's about investing you. Angel investors, high net worth. Sometimes you'll hear people talk about family offices. These are just really, really rich people who now actually have some degree of structure to their investing. So they're not just backing you. They now have a thesis. They're now saying, hey, we think this is a great business, this is a great space, and we want to help you get off the ground. And then the last bucket is you'll hear about venture capital, private equity firms that invest. Just to help everyone understand, private equity is any equity that is not public, right? So the NASDAQ, the New York Stock Exchange, that's public equity. Private equity is anything that's not traded on an exchange. So that could just be an investment. So that can range from, some of the biggest companies are actually privately owned, all the way down to small startups, which are privately owned. We call usually the earlier stage companies venture capital, but private equity really addresses all of this. Again, this is meant to be a framework for you, not necessarily one size fits all and a universal categorization, but just to give some people guidance. You'll notice in the little red box down there, I put investment bankers. Investment bankers are people who help you raise capital. So, you have a friend who says they're a banker. Bankers are people who work at banks. Bankers are people who loan people money. Investment bankers are people who specifically help entrepreneurs raise capital for their business. And so an investment banker would help you find angels, high net worth folks, and venture capital for an endeavor such as yours. I do think it's important to talk about, before we get onto the financing piece, about the fact that there are other forms of capital out there, right? So there's always going to be ways to find capital, and it's a question of how scrappy you want to be and how much you want to dig, right? So people bootstrapping usually refers to putting your own money in. There are these special incubators where they will help you start your company. There are grants, specifically small business grants. Banks will sometimes do loans, usually not in the marijuana space, And then there's even like nowadays there's crowdfunding, right? So people who will either Kickstarter campaigns, Indiegogo. And then there's other things, more traditional business, so vendor financing, where your vendors will essentially give you really good terms and loan you money, and customer financing, where people will give you money down deposits. The point being, there's financing everywhere. It may not be what you need, but it's there and you have to go find it. The reason I put the emphasis on this is that, one, raising money is hard, right? It takes time and it's not gonna happen as you want it to. So you're gonna enter in this process and you're gonna say, okay, I'll give myself 4 to 6 months. It's invariably gonna take longer, or you're gonna hit a hiccup. And so you need to have other options. And then two, the other thing to remember is that investment capital is expensive. People like me put money in companies, not out of the goodness of our heart, but to make money. And so you have to remember that investment capital is expensive, and you don't want to take boatloads of it just for fun, but really it needs to be to an end goal, and you have to find the right fit. We always tell our entrepreneurs, if you have access to capital, you should explore everything. All right, so here's again, going back to a basic framework of how to think about financing. You've got debt vehicles, where someone loans you money. You've got equity vehicles, where someone owns it. And then you've got, I call it management agreements. It really can be all sorts of types of agreements, and I think you actually have or maybe you don't, a session on licensing, franchising, so there are other types of agreements where people are contributing something to be partners. Debt, I think a lot of people are familiar with, right? Someone loans you money and then you have to pay back that money. When we talk about what an investor is thinking about, an investor is thinking about, are you someone trustworthy? Are you someone I can believe in, I can trust, I can loan money to? And then at the same time, they're saying, okay, well, is this debt secured or unsecured? And secured means, hey, is there something there that if this person doesn't pay back the money, I can take it back? And that's the collateral. And then on the flip side, from the entrepreneur side, you're sitting there thinking, okay, well, did I sign away my whole life? And you're thinking about what happens if I don't pay back the money, right? Obviously, you shouldn't be taking money out if you don't think you can pay it back. But the idea would be that you want to understand, we'll talk about default. That's when you don't pay things back. You always need to think about, okay, what's default? And that's where you're going to spend all your time negotiating. So if I'm 5 days late, is that default? If if someone else is asking me for money and I don't pay them back, is that default? All your focus as an entrepreneur is going to really be on what's the default and then what the remedies are. What can people do if you default, right? Can they come take your house? Can they do nothing, right? So that's how debt is structured. It comes down to someone loaned you money so you can buy a lemonade stand. Equity, on the flip side, is someone is actually investing money so they can actually be a part owner of the lemonade stand, in this example. A lot of the things that, as an investor, you're focused on, okay, well, do I like the business? What's the valuation? How much am I getting for the money I'm putting in? And then how do things play out, right? So if money comes out, do I get it first? Does someone else get it first? That's called preference, the preference of return of capital. The rights I have, do I get an employee discount? Do I get the ability to have my cousin work at the place? Do I get to hire people? Do I get a credit card? Do I get to make decisions about the business? And then the last piece that we talk about is governance, which as your last panel talked about, presentation, it's about decisions at a corporate level, right? How you run the business. And so it's important to think about this. You're actually taking on a partner when you have equity, right? So someone is not loaning you money and you're doing something with it. Someone is actually partnering with you on this particular endeavor. I put here as a zero-sum game / partnership, right? The best equity investments are things where it's a win-win, where you're like, I see the world the same way you see the world. You bring something that I don't bring. We're very thoughtful and we get along. The worst case equity investments are, hey, I get this and you don't get that. And this is how it goes, tit for tat, tit for tat. It is in many ways a zero-sum game because it's a partnership, but doesn't mean it has to be a bad partnership, right? It's about aligning that and having that open conversation. And then the last thing to talk about is management agreements. And this is I'd say a marijuana specific thing. You can do going with the lemonade stand analogy, right? It's as if Minute Maid came to you and said, hey, we want to partner with you. Or, and that they're contributing their brand or their supply chain, right? For any of you guys from the East Coast, like Dell's, right? Who they have that really soft frozen lemonade stuff. Like, if they wanted to contribute something to your company, and in exchange they get either ownership or they get paid back, right? So they're contributing something. A lot of people also contribute operational support. Running a marijuana business is not easy. It's actually quite hard. And there's some people who've been doing it a little longer. And so they're going to say, hey, we've got this kind of played out. We have SOPs, standard operating procedures, and we know how to do this. Why don't you let us come in and run this, and then we'll get a piece of it, right? So that's a management agreement. There are a lot of management agreements in the marijuana industry. And I think as your previous presentation talked about, some of them are pretty shady, right? Some of them are predatory. While other ones are actually good partnerships. I think the key to any type of partnership, and I think I mentioned this at the top, it's understanding what's in it for you, and it's also understanding what's in it for them. And if you can't identify that, then then you're behind the eight ball there. I did say I talk a little bit about how marijuana is specific in this space. I think it's important to understand that your options for debt and equity, as compared to the regular entrepreneur, are substantially limited, right? A lot of people, Bank of America will not loan money to you. A lot of people will not participate in this space. Insurance companies won't. A lot of individuals won't. And so your sources of financing are greatly reduced. I think another thing to remember when you're in the marijuana space is that expectations are higher, right? So, if I'm investing in an ice cream shop and I'm getting 8% or 12%, I'm thrilled. But marijuana is something that is a high growth, high risk industry. And so people have different expectations of what they get out of it. It was briefly touched upon in the previous panel on legal, but there is a lot of taxes in this industry. The most common one that's new to people, 280E. It's a provision in the tax regs that say you cannot deduct ordinary operating expenses. What it means to you as an entrepreneur, it means you may on paper make 20 bucks, but you have to pay a lot of that to the government, far more than you would if it were a regular industry. And so what happens is, if it takes this much in sales to break even, if you're owning an ice cream shop, for a marijuana store you probably have to do more, right? So it's a lot harder. It's harder. The way we say it in the industry is that in the financing industry, it's hard to generate organic cash flow, right? It's hard to make money. Normally you used to think you made money, and then you have so much money, so much cash to spend. In this industry, so much of that goes to taxes that you actually have far less. And then the last thing to remember, the fourth thing that I'd say is important to understand how cannabis is specific. What's specific about cannabis when it comes to the financing landscape is there's no bankruptcy. Now, bankruptcy is hopefully something we're not all super good at. It happens, but bankruptcy exists. Bankruptcy is actually a federal concept by and large. So if you think about people who file, you've heard about airlines filing Chapter 7, Chapter 11. That's not available to most cannabis businesses because still, by letter of the law with the federal government, that's a federal process. So those are a couple ways that the marijuana industry is different than most entrepreneurship. Going back to that concept of people have higher expectations, we always talk about it as risk reward, right? You can invest in many ways, and for me as an investor, I look at a lot of different things. I look at things that are super risky, and I look at things that are not so risky. And the way I think about them is, well, what's the risk reward relationship? If I'm looking for something, if I'm investing in something super risky, well, I want to make more. I want more upside. Whereas if I'm investing in something pretty secure, I don't need as much upside. So we always talk about the risk reward relationship. In that, the type of security you take actually affects that, right? So senior debt tends to be the least risky for an investor, right? Because it's senior debt, it's often secured, meaning it's tied to real collateral, it's tied to the building, it's tied to a personal guarantee, it's tied to the equipment. So there, it's very low risk, but then presumably the return is not as great. And then the other thing we talk about is where it is in terms of liquidation, right? So if everything, everything blows up, the senior debt is paid first. On the other end of the spectrum, you have common equity. Common equity has the highest risk because there's nothing securing it. They're the last ones to get paid back. So people, when they're taking common equity, actually usually want the highest return. And in between, there's a whole spectrum. I mean, it's like a craps table. Investors can craft anything they want in the middle, right? And they're going to come at you and they're going to say all these different words, and they're going to say, well, I want something where you pay me back this rate, and then upon that, then it turns into equity and I get an ownership percent. They're going to say all sorts of different things. At the end of the day, the framework is the more risk they take on, the more they should be compensated, and the less risk they take on, the less you should have to pay. So having said that, I'm going to throw out a couple of buzzwords that you may hear in a financing process. You can read the slide, a cap table, ownership percentage, anti-dilution. I think I actually heard your law panel talk a little about this. A couple I want to flag: multiples. People will talk about, when they're talking about valuations, how much your company's worth, they will often talk about it in terms of multiples. Multiples is really a shorthand. So all it is a multiple. So if you say your company is a multiple of revenue, well, if your lemonade stand did $50 last year of sales and you're valued at 2 times, well, then you're valued at 50 times 2. All it is a shorthand. It's not to say that the investor is actually thinking that's how your business is worth, but in that multiple is built in a lot of assumptions, right? What your future growth rate is, what your risk. But when they communicate that out, it's just a lot easier to talk in multiples. So to give you an example, marijuana companies right now in the public markets will trade from anywhere, from 2 to 5 times current year revenue. So if you had to, guesstimate what the value is, you'd say, okay, well, what's the revenue for this year? Two times that or 5 times that is the range. Obviously, that's a big range. But again, it's a shorthand. People are going to talk a lot about multiples. It seems like there's a lot that goes into it. It's all internal for the investor. When it comes down to the entrepreneur, when they're accepting capital, you just need to figure out ownership and whether that's a good deal. Pre-money, post-money, sometimes it trips people up. So pre-money is what is the value of your company before the money comes in, and what is the money after, right? So there's a pretty straightforward example. If the company's valued at $5 million pre-money, that's what the company's worth before you put in money. Now, if someone puts in money, well, theoretically that company's worth more, right? You have $5 million is what it's worth plus $2 million of cash. So now the post-money is 7. In many cases, a lot of entrepreneurs will spend in advance of receiving that money, and so you have to be careful when you're thinking about what the post-money is. But it's the idea is what is the underlying business worth and how much cash is coming in. Together, that's the post-money. And then another concept I think that's important to break, to differentiate, is primary versus secondary. So when investors invest, if an investor is investing in you and they're investing in your company and they're buying a piece of it, that's a primary investment. If they're buying some of your ownership and they're actually buying some of your equity, then that's a secondary investment. So let's just do we got our lemonade stand, we've decided it's worth $100. And so if someone is investing and it's primary and they're going to give you $50 to invest in your lemonade stand, now the post money, right, is the 100 plus the $50. So now the post money is $150. That person put in $50, so they own a third of that, 50 divided by 150. So now they own a third of that. Now, if were doing secondary, where they're not investing in your business, but they're actually buying some of your business, so your lemonade stand's worth $100, and someone gives you $50 for it, you take that $50, you pocket it, because it's yours now, but now they own 50% of your business. They own half of it. So it's important to understand primary versus secondary. There's other things, paid in kind, warrants. Warrants, I think, important thing, warrants are the same as options. We just use them. There's some minor differences, but nothing, really, again, it's the concept. I think just remember, the vocabulary gets complicated, but the ideas don't. That's why you often will have an advisor. Advisors are people, professional, who are paid to do this. They're trusted confidants. There's sometimes people who've done this before. I think during any fundraising process, it's crucial to have advisors. It's crucial to talk to people who've done this. It really helps, right? Because their job is to understand all those little nuances and help you make the right decision. Here we have a couple of structures that are worth talking about, because these are probably going to be the most common financing structures you'll see. A simple agreement for future equity is a kick the can down the road agreement. You're saying, hey, we're not going to do all the paperwork. We're just sort of putting something down, and this is what the ownership is. It's a form of equity. Then convertible debt is something where you are taking on debt, but under certain conditions, that debt flips into equity. So it starts off, it's kind of, from an investor point of view, it's kind of best of both worlds. So at the beginning, I'm secured, I have debt, I've loaned you money. But if your business is doing well and things are hitting certain milestones, I have the right to turn that debt into equity. And so now I can then say, don't worry about it. You don't owe me $100. Now it's like I invested that $100 into your business. Preferred equity is different than common equity. Preferred equity usually means that you have special rights, right? So often it's in who gets paid first, right? So if you and I each own our lemonade stand, we each have invested $50, but mine is preferred equity, usually I'll get my money back first. So we may own it 50-50, but if $10 of profit comes in, that $10 goes to me. Or goes to the preferred, not me. Goes to the preferred before it goes to the common. And so that's preference. There's usually a lot of different things, but preferred equity is think of it as very favorable equity. Common equity is exactly what it's common, right? Everyone's even Steven. Founders are usually common equity. And then the last we have is senior secured debt. That's often something you'll encounter where people say, hey, I'm going to loan you money, but by the way, you have to sign your name over here, personal guarantee, or it's secured by your car, it's secured by the building, it's secured by the equipment. And if for some reason you don't pay or you do something bad, I have the right to go take that. I might have the right to take your business as well, depending on what you negotiate, but I also have the right to take the security, the underlying security. These are the most common structures. On the slide you've listed, there's some of the features associated with them. Again, the intent is this is a framework. You don't know what you're going to get. As an entrepreneur raising money, you're going to go out to the market and say, I want this. And if you're good and you're lucky, you get that. But often you'll get offered something else. And so you have to be able to understand the trade-offs and how to think about these things. An important thing that a lot of people don't talk about too much is how do investors fit into this? And I'm not going to spend a lot of time on this, but I think it's important. I always tell entrepreneurs, even the ones we're investing in, is understand what you're getting out of this, right? If you're an entrepreneur, what are you getting out of this investment? I always use the example of pot of gold at the end of the rainbow, right? That's success in your business, right? And by this investor investing, did that pot of gold get bigger? Are you closer to getting that pot of gold? Or are you able to get that pot of gold faster, right? The investors need to do something. There's capital, right? The money is important. But they also should do something that helps you improve your operations, improve your chances at being a successful business operator. Likewise, you yourself as an entrepreneur, think of it this way, your investment is the business, right? It's already made. And so you also have to understand your risk reward. So when someone proposes, debt, well, do you feel good enough about your business that you're willing to put it on the line? It's cheaper capital, it doesn't cost as much, but are you secure enough that you're like, I got this, everything's gonna be fine, and I'm comfortable doing that? Or are you on the other side, like, this is everything I own and I can't lose it? Well, yikes, I wanna sell some secondary, or I want a different type of structure. So it's important as an entrepreneur to think about your risk reward as well when you're thinking about financing. If you're successful, your business will grow from here to here, right? We talked about that. There's a question of what your role is in that and how that changes over time. At the beginning, usually, I think most good entrepreneurial stories start with everyone, someone's doing everything, right? They're out there talking to customers and they're cleaning the bathroom, right? And eventually you get all the way to the end where, there's a CEO, there's a corporate structure, there's a lot of people doing a lot of different things. Well, where do you fit in? At the beginning, it's obvious where you are, but as the company grows, is that what you want? Is that what you're good at? And trying to understand where you fit in is a crucial aspect. The reason I bring that up when it comes to financings is because then there's the question of, well, what's your compensation for whatever you're doing, right? I list there a couple things you could talk about. What's important to different people. Ownership, equity is obviously something that people retaining ownership, but there's also salary, there's also your title, and there's also future equity options, right? Something that a lot of entrepreneurs, you should understand as an entrepreneur, a lot of investors don't like when an entrepreneur or a founder is asking for a big salary or asking for a big employment contract, because the investor wants you to put it all on the line and really have your success come through the equity, because their success comes through your equity as well, right? So if they're aligned, and again, I think this was a previous presentation, if you're aligned, then the investor feels better. Now, if an investor is a debt investor, they don't care. As long as you don't, as long as you can pay them back, that's all they care. But if you're an equity investor, they want to make sure they're aligned with you. And so they don't want you taking a big salary, buying a corporate jet. They want you right there with them. And then a guiding principle for this is that last bullet of how do these deals look? How does it pertain to you? It depends on, do you look more like an owner or do you look more like an employee? In some cases where people have raised money, they find themselves not owning that much. And when you don't own that much, you actually look closer to an employee. And so understanding what's the right compensation to ask for and how all this fits in depends on your own vision for this organization, but also your vision for how you fit into it. So that's a more relevant conversation over some kumbaya and some a beer. But it's important to understand that there's a lot more that goes into understanding how you personally as an entrepreneur fit into your capital structure. So that was a lot, but hopefully it gives you a framework on how to think about financing and approach a financing. So when you get that, you're on the portal and you log in, next year, and your first thought is amazing, and your second thought is, I don't want to mess this up. This is helping you understand how to finance it, how to build that business, and some of the things to think about.